What is happening, everybody? Good morning. This is the Flow Show. I'm Sean McLaughlin. He is Steve Straza. Steve, how was your weekend, buddy?
It was great. How was yours? Nice Easter?
We had a nice Easter. My son and I went to our very first Denver Nuggets game yesterday. Great
No
time.
kidding. Well, that's awesome. How was
Yeah,
it?
it was a great time. My son plays basketball, as we've talked
Yeah.
about in different places. He's 9 years old, and the league got like a deal of tickets with the Denver Nuggets, and so we went to the game. Of course, the tickets were no exaggeration, literally the top row of the stadium. That's where they give you the little league tickets to.
Yeah.
But it was great, man. The Nuggets dominated the Cleveland Cavaliers, beat them by like 30 points. Jokic, was a stud. Great time.
He's so fun to watch. That's awesome. How close are you to the arena?
Oh, I'm like an hour drive. It's in Denver. I'm an hour outside of Denver, give or take. But totally worth it. Totally worth it. All right, so this is the Flow Show, and what Straza and I do here is we walk you through our process, how we land on trade ideas. We don't always land on a trade idea, but we usually do. And let's start at the high level here, Straza. You and I, right before we went live, we were talking about the VIX. VIX, showing it's getting a little spicy. Maybe it's the highest it's been over the past, I don't know, 2 weeks.
Yeah, a
What's going
couple of
on there?
weeks. It's listen, 7%, 7% and change on the VIX so far here today. Yeah. Can I just say what great information is in our trading accounts? So Thursday, I I'm looking through this weekend and I just found, okay, I got stopped out of a lot of things Thursday, right? Action didn't seem so bad if you look at the indexes or the major averages. Whatever. It's getting stopped out of a lot of positions. I don't know if you saw the same thing. Then today, we're really getting this downside follow through. Volatility index up about 7% here. It's more of a growth mega cap theme. I think there are still some areas working, which are the ones I want to talk about today. But it was all right there this weekend when I was reviewing my account. And
Well,
then
what's
right
interesting,
today, I
Straza,
follow.
is that I have not gotten stopped out of anything in the last week.
Really?
However, I did get stopped out of something today, and it was a short position. I got we've been short Mosaic MOC or
Yeah.
MOS,
Yeah.
and finally got stopped out today.
Not getting stopped out of that Lulu short, though.
No, the Lulu is working. That's the only short, let's call it hedge that we have on left from back when JC had his little temper tantrum about the market's about to roll over. So we
Right.
put a few hedge positions on just in case, and they've all been stopped out except one. That's Lulu, and Lulu might hit our profit target here pretty soon. We'll see.
This mosaic does look like it's squeezing higher. You don't want to be short that. Yeah.
Yep, we are out. And well, not too bad. We bought puts in that thing. They were June puts, May puts. May puts. And we paid $2 for them. Got offered 91 cents today. So, hey, that's not bad. It's a loss, but not a terrible loss. We'll take it.
So let's talk about the things we're not getting stopped out of. In fact, there are things that are working really well. Are you noticing your commodity stock positions, your steel positions?
Yes. In fact, one stock that's starting to rip, but I'm running out of time because it's a position I've been in a while, and we have May options, is Next Gen, NXE, finally starting to go.
Maybe we put on another one there.
Yeah, I mean, it feels like a fresh setup right here. I mean, that's the stock I mean, if I had no position and I'm looking at that chart, I'm like, yeah, that's something I want to get long. So that's an idea.
So that's the theme, right? Let me throw up a couple charts. End of the week, quarter, or I'm sorry, week, month, and quarter, Thursday. So we're zooming out on our charts. We're looking at these long-term charts. A couple that stood out. Here is the iShares North American Natural Resources ETF. This is a commodity stocks theme, right? You're getting some sort of a breakout here from this multi-year range. Maybe it needs a little bit more time, but we're very close. And when we look at peer indexes, this is the large cap energy sector spider. Zoom out to weeklies. Yeah, some context. Just awesome advance off of the pandemic lows, straight sideways for about 2 years here. Now getting that upside resolution, energy is a place where I think we're going to want more and more and more exposure to as the year goes on. And again, not just energy, not just oil and gas, it's a commodity stocks theme. Here is the large cap materials sector spider, right? We could draw this similar here. Again, on the weekly, getting some sort of a multi-year range breakout. I think the way we probably want to play these in terms of crafting like trade setups is giving them a lot of time. I think we want to go to at least January of next year because I mean, this is a weekly chart. Materials just set their record something like 10 straight up weeks, right?
That's
These groups
amazing.
deserve a breather, but over longer time frames, right? The primary trend is very much higher, getting these breakouts. I think over the next 2 to 3 quarters, these are the places we want to be.
All right, just first thought, without even looking at any setups yet. When I hear you say we just had a record run, 10 weeks in a row, probably due for a pause, but we want to position for the longer term. My options trader mind says, I'm probably thinking calendar spreads here, right? Like things that might take a little bit of a while to get going. So maybe we can earn some premium to reduce our cost while we wait.
So it's a sideways bet that morphs into a bullish bet.
Right. It's the way I think of it is I could position in a call calendar spread, a little bit out of the money, above, current prices, and it gets me in a position that if the thing rips now, I'll make something. I won't make what I'd like to make, but it'll be a profitable trade. If it takes its time building, which you think it might, because we might be in for some digestion here of a recent run, then those short calls that are part of the call calendar spread decay away. Maybe we can roll them out for another month, bring in some more premium, lower our cost basis. Do that a couple times, and before you know it, you got a good trade on your hands.
You want to look at some charts?
Yeah, of
I
course,
think
of
I
course.
think this one's I think this one's good for it. I wouldn't have brought this one up if you didn't just explain call calendar spread, right? And tell me that that's where you want to go. And I'll show you why. Because this is Freeport-McMoRan. So this is a bellwether industrial metals stock. You have the nice advance off of the pandemic low shown on the left-hand side of the screen. And then we have another one of these just giant multi-year ranges. And you're going to get confirmation that this range has resolved at about 52, but you do have a level here beneath it. You could very well draw this chart like this, right? And treat these Q1 2022 highs as a kind of blow off. But if we're doing the call calendar, we could bet on sideways maybe here until we get to these old highs, confirm the breakout. No? What do you think?
Yeah, I'm just kind of ripping through the options chains here a little bit while you're doing that, and I'm thinking, if I were to do a call calendar spread with the stock at what is it, 47 and change. So what's that high in early 22? Is that 55?
I think it's like 52. Let me see. It's about 52.
Okay. Well, unfortunately, in May options, we either have a 50 strike or a 55 strike to choose from. So 55 strike is probably where I would look. And if I did that, maybe if I did like January options at the 55 strike cost about a little bit more than $4. We'll call it 410. So if I bought January options for 410 and sold May options at the same strike, the 55 strike, I can get about 58 cents, let's call it 60 cents. Not a whole lot, but it's far enough away that they'll probably expire worthless, at least in May, unless it rips right away.
Yeah.
But we'll probably get a couple opportunities to roll those short calls to bring in additional premium, which lowers our cost. Um, I like it.
So 6 weeks, basically, uh, this thing continues to work its way out of this little base, right? It has six
Mhm.
weeks to get that upside resolution. Then we take off the shorter dated calls and leave the longer dated calls.
Yeah,
Well,
I'm thinking we sell the May calls. Maybe we get an opportunity to roll them one time into June just to
yeah,
bring us some additional credit. I mean, at some point, we're going to want the open-ended exposure, right? We don't want to cap our upside.
right.
Um, so I might have to think about this a little bit. I mean, It might have to be one of those discretionary decisions, when the time comes, like when the short calls have decayed in such a way that there's really no premium left. Up at that point, am I rolling for more credit, or am I just letting it expire and then sticking with the long options? I'd have to think through that a little bit, but I think there's an
Would you?
opportunity here for at least a couple rolls. And then if the thing does run on us faster than we think it will, we'll still be in a position to profit, which is a good problem to have. Just not the profit we would hope to have if we had uncapped upside.
But would we cover the shorts on a breakout above 52?
No, we would cover the shorts on a break above 55, which is the short strike.
Got it.
Because you're still, when you know what, Gene, you might want to go to my screen here real quick. I'll put together a calendar spread trade that we can analyze here and show you guys what that looks like. I did an upside down calendar spread. We don't want that. Okay, so check this out. This is what a P&L graph for a call calendar spread looks like. We're right here. This is where the prices are right now. Our strike prices would be 55, which is right here. All right. This purple line shows us what our P&L would be today if FCX, rose across these range of prices. So as you can see, the P&L graph today continues rising until we get to 55, which is what our strikes are, right? So yeah, if we break 52, we're still making money on this spread if we move up to 55. So might as well hold it. But once we get to 55, then we're on the back side of this spread. By the way, the blue line here, this shows you what the P&L curve of the trade would be on the expiration of the short options. So those May short calls. Like if this was expiration day and we're sitting here at 57 bucks, then, we'd be sitting some profits there. We'd be making about 1,200 bucks here on a 10 lot, give or take. That's a estimation, of course. But yeah, 55 is where we would take action. We don't want to be on the backside of the curve here because obviously the higher we go up, the less money we're making. So that's my best practice. I mean, other people have other ideas on how to do that, but if we're in between, let's say 50 and 55, actually anywhere below 50, anywhere below 55, when the short calls expire, in this case, the May short calls, we could roll those out to June, bring in a credit. The amount of the credit will depend on how close we are to the 55 strike, right? Like if we're at $54, we'll get much more of a credit for that roll than if we're, say, at $48. We'll get significantly less.
Right.
But if we're below 55, we can keep rolling. We can keep bringing in some more credit. But again, I mean, I have to use some discretion here because let's say we're at 54, right? And I've got the June calls. I've done one roll. I'm in the June calls. They're about to expire. And the trade's looking great, right? Like it's above that resistance of 52. Like maybe at that point, I don't do any more rolls. I just keep holding those longer dated calls and just go with it.
That's what I'm thinking. And to be clear, what the P&L chart's showing you is the combination. It's not showing you the profit potential from this trade if and when you close out the short calls.
I just realized that. I mean, everything I said still stands true, but I just realized that I was showing the wrong expiration for the long options. I was showing June expiration instead of January. I'm thinking we want January's. Changes the math here a little bit, but it still remains the same. Here's where we are right now. And if we got to 55, actually, we'd be doing really well. If we did a 10 lot, right? I'm sorry. This is where we are right now. What's going on here? Oh, there we go. There we go. Now it looks right. See, look, I'm like a newbie here. First time I'm using this software. I've only been using it for 25 years, but I'm acting like I've never used it before. Now it looks right. But yeah, if we did a 10 lot, which would cost us, it looks like the spread we could enter it right now for about 357. So that's a $3,500 investment, right, for a 10 lot. And if the thing ripped up to 55 today, I'm not saying it's going to happen, but hey, we'd be sitting on about a $1,300 profit. Not bad, right?
No, I like this. I like this trade a lot. I think Freeport, not only is it an excellent vehicle, it's very liquid, right? So it's good for an options trade, but this is the right group. I just want to show a couple other copper charts. This is the global X copper miners. Like, why do we want copper? New multi-year highs. This is the index itself of copper stocks. Copper futures looking good. Gave a little bit back last week, but here's one of the industry leaders within copper. This is Southern Copper Co. Sean knows this chart well, right? We're betting on Freeport to play a little bit of catch up with some of the other names in the space. This was just an awesome breakout for
Yeah.
Southern Copper Co. And look at how this one, just legged right up after it resolved this range.
I have a little FOMO on that one because we talked about that in an analyst meeting before that big break. I think you called it out, and I don't know
Look at
why. I
this
don't
thing
remember
go.
why we didn't do it, but or why I didn't do it, but oh well.
I was long this one last year, got out because of a time stop.
Hey, you got to
Yeah.
follow your process, buddy. Nothing wrong with that.
You know?
Hey, there's a question here in the chat I want to address here from Frey Lee. He says, "Can you explain how to determine when to do a call calendar spread? Is it just when you think it's going to go sideways?" Not necessarily, Frey. I don't know if I'm saying your name right. When I want to do an upside call calendar spread, it's because I think the stock is going to take its time getting moving. Like, perhaps we're positioning a little early. And as Steve mentioned earlier, the stock has already had a pretty good run, a pretty strong run. The sector has already had a pretty strong run. So it wouldn't be surprising at all for the stock and for the sector to just take a little bit of a breather. But we want to be positioned in case we're wrong, in case, no, this thing's just going to keep going. It is going to keep going, and we're not early. Now's the run. And so it's kind of like a hedge, right? Like, we think it's going to take its time, but if we're wrong and the stock keeps going, we can still participate. We can still make some money. That's often when I'll put a call calendar spread. When I think if I'm going to be wrong, I'm going to be wrong in the direction that I want to be wrong in.
There's some sort of bullish bias. The pattern's setting up, but maybe needs confirmation or is not quite complete. Or like you said, these stocks have been on a massive 10-week run, due for some digestion, a little backing and filling. But we're always betting on an eventual upside resolution or pattern breakout with these strategies, no?
Yeah. Yes. And you know what? We don't talk about this a lot, Straz, and mostly because we've been in a bull market for a long time. But put calendar spreads are actually really great trades when you think a stock is ripe to sell off and volatility is low. Like, it's one of those ideas that, like, the market's not paying attention to. Nobody thinks this stock can go down, but for whatever reason, your analysis says, no, I think this thing has the risk of the downside. In that case, a put calendar spread is a great trade because a put calendar spread is obviously it'll have a directional bias to the downside if you're doing it out of the money strikes. But more importantly, it's a long volatility bet. So if volatility rises, the call calendar or the put calendar spread will actually, all else being equal, the value of that spread will rise, because what happens is when stocks go down, volatility tends to rise, and volatility will have a greater impact on the further dated options than the shorter dated options. In this case, if we're in a put calendar spread, the short put expires in 4 weeks. The long put might not expire for 4 months or 8 months. So it's got more time. So an increase in volatility will magnify the value of that long put much more than it will the short put. And so you'll get an increase in the value of the spread that way. So you'll win from the directional bias, and you'll also win from the volatility increase. But we haven't put many of those trades on lately, Straza, because we haven't been looking for bearish bets.
That's great info. Very educational. Why are you talking to me about put calendar spreads? It's a bull market.
I'm just saying, I'm just trying to give a full rounding picture of why calendar spreads can be great. They have their time and the place, like every option strategy. They have their time and place where they work best. Hey, I see a cat in the screen there. Meow meow. Is that Lola cat?
Lola knows when the camera's on, dude. She loves it.
All right. Well, on that note, obviously Lola needs to get fed, so let's take care of business. We like Freeport-McMoRan, FCX. We like a call calendar spread, buying the January 55 calls, selling the May 55 calls to help reduce the cost. Looks like right now you can get in for about 360 debit. That's, by the way, that's the most you can lose if you're absolutely dead wrong in this trade. The most you could lose is the debit we pay today. If the stock goes to zero, obviously that's the most we could lose. We could also lose, it should be noted, if it goes too far above our strike. If we're so right on this Straza, this thing just rips immediately.
Yeah.
And it goes all the way up to, like, say 70. Well, look, on the backside of this, you could also lose the maximum amount. So you got to be careful. If we get to 55 while we still have the spread on, we'll just close the spread, the whole spread down, book the profit. That's how I'm doing it, Straza. How'd we do?
I like it. This is a good one.
All right, everybody. Thanks for tuning into the Flow Show. We'll do this again next week, barring any random market holidays. I'm always the last guy to know about holidays. I didn't even know we had Friday off last week until like Thursday.
You're kidding.
I had no idea. I had no idea. That's how I am. But we'll do this again next Monday. And otherwise, we'll see you on the morning show tomorrow, bright and early. Straz, have a great day, buddy.
Thanks for watching, everybody.
See ya.